Okay, for this Form 7203 video, I wanted to cover a unique election available to S corporations. And so the election is stated here at the top. It's Regulation Section 1.1367-1G. And so this election is made in order to kind of reorder the way you adjust your stock basis in the S corporation. So I've got two slides in front of us outlining the rules and the fact pattern we're going to look at. And then as far as the returns and the K1s, I do have the K1 for our shareholder. So our shareholder here is going to be Jane Doe, and she's a 20% shareholder in this S corporation. And then we have two versions of her Form 1040. So we have one 1040 with the 7203 where we're not making this election, so we're just going to use the default treatment for ordering. The ordering rules on adjusting our basis, and then we have a second Form 1040 and a second 7203 where we do make this election. So we'll go through all these elements and then try to clarify here why it is that this election exists and why you might want to consider using it or just stay away from it. So some basics on shareholder S corporation stock basis, right? So your stock basis, when you think of the starting point, it's always initially the capital contributions to acquire the stock, right? So if you're an original shareholder in an S corp, the money you put into the company in exchange for the shares, that's the initial increase to your S corporation stock basis. And then any future capital contributions will do the same. There'll be increases to your basis. Now, the normal ordering rules for when we adjust our stock basis up or down, it's in this following order, right? So under 1367-1F, your stock basis by default is increase for income items and excess depletion. It's decrease for non-dividend distributions. And then the third step is a decrease for non-deductible expenses, right? And then very last, you do decreases for items of losses or deductions, right? So, for example, if we're looking at the K1 for Jane Doe here, line 1, right? So line 1, ordinary income or losses, the 8,017 loss. Under the initial ordering rules, that item would come as number 4 when we look at the ordering for adjusting Jane Doe's basis in her shares. Now, this election, this 1367-1G election, it reorders these items. So if you make this election, the first two are the same, right? So you increase your stock basis for positive income items and excess depletion. You would decrease your stock basis for non-dividend distributions. But the third step now is you are decreasing your basis for losses and other deductions, and then non-deductible expenses come last. Right? So everything is the same except we're just switching around item 3 and 4. Right? Now, if you decide to make this election, you have to keep using it, right? So it's an irrevocable election. You keep using it unless you get permission from the IRS to change it. So now that we've covered, high level what it is that's happening here, let's start looking at the details a bit more, and then we'll see on the return how this makes a difference on Jane's tax return. So when we have not made the election, non-deductible expenses reduce your stock basis to 0, right? And then you can use them to reduce your debt basis as well. But to the extent that you have any excess non-deductible expenses over your stock or debt basis, those excess non-deductible expenses are just forgiven, right? They're eliminated. They don't get carried forward to subsequent tax years. So this is generally a good thing, right? Because non-deductible expenses reduce our basis, which is generally not a good thing. We don't want to reduce our basis. We want to keep it high because it allows us to use losses. If we sell the stock, we have a higher basis, so we reduce our capital gain, right? And so that's why non-deductible expenses are generally not a good thing from a basis perspective. So by not making the election, if we have a lot of non-deductible expenses and we can't use them all in a current year because we don't have enough basis, they don't roll forward to next year where you can just get rid of them, right? Now, this is the costs that you make with, or that you have with making the election. If you decide to make this G election, right, so you get the benefit of claiming the losses first, right? That's step number 3. But if you have non-deductible losses in excess of your stock basis, those excess losses or those excess non-deductible expenses do not disappear, right? You have to keep rolling them forward until you have enough basis to use them, okay? And so that's the problem, is these non-deductible expenses, if they reduce your basis to zero and you have extra, they're following you forever until you use them. Okay, so that's generally not a good thing. We don't want to do that. So let's look at Jane's 1120S K1 and then the tax returns. And I think when we see some numbers down on paper, this will make a little bit more sense, because I can appreciate that reading the words, it's often difficult to grasp some of these concepts. So the fact pattern we have here, we have Jane Doe. Again, she's a 20% shareholder in a consulting business. And so the consulting business spends a lot of money on meals and entertainment expenses, meeting new clients, right? Existing clients, meeting new clients. So the meals expenses are only 50% deductible. Entertainment expenses are not deductible. So the company has a lot of non-deductible expenses. So if we look at the 1120S here, so we've got a 2022 1120S Schedule K1 for Jane Doe. Right, she's a 20% shareholder. So the items that are of significance here, she has a line 1 ordinary business income loss, so ordinary business loss, some interest income being allocated to her, and then line 16C items, which are the non-deductible expenses. So you can see here that she's got the non-deductible meals, the entertainment expenses, non-deductible. So she's got a very large portion of non-deductible expenses, $16,500. So when we have a look at her basis worksheet, so this is a basis worksheet prepared by the S Corporation for Jane Doe, but this is not to be used by Jane exclusively, right? This is information that might help her prepare 7203, but ultimately the 7203 is what's most important, right? Each shareholder is responsible for reporting and tracking their own basis. They shouldn't rely solely on these types of schedules prepared by the S Corporation. So when we look at Jane's stock basis, she has a $6,000 increase for her capital contribution. Okay, that's fine. That's normal. A $21 increase for the amount of interest allocated to her. So her basis, before accounting for any distributions or non-deductible expenses, this is line 6 here, is $6,021. Now, the non-deductible expenses, remember, it was $16,500. So on line 7A, when we input a decrease for non-deductible expenses, it is limited to just the $6,021, because remember, your non-deductible expenses, assuming no election is made, that's claimed first, and it reduces your basis down to zero, and then any extra is just immediately wiped away, right? It's not carried forward. So that's what Jane's basis schedule looks like, assuming she didn't make any kind of election to treat it otherwise, right? So now let's have a look at her 7203, and this is the example where she did not make the election. So we can see here Jane Doe's a shareholder, Fake Consulting Group is the S Corp. She has one block of shares, right? So block 1 is this specific stock block. She hasn't acquired any new shares or sold any. And she is the original shareholder. Now, item E, notice we aren't checking this, right? So what we're doing for the ordering rules is just the default standard provisions. So you see the basis reconciliation, very similar to what we saw on the schedule that was part of our K1 package. So we have a $6,000 increase from capital contributions, $21 in interest income. So her basis before distributions and before non-deductible items and losses is $6,021. Now remember, we have not made an election to reorder this. So the basis of $6,021 is first reduced by her share of non-deductible expenses. So there's the $16,500. Now because that amount exceeds her basis is reduced to zero. So we see here on line 10, basis is reduced to zero. And then those extra non-deductible expenses, they just go away, right? They disappear. She doesn't have to carry those forward to the next tax year. Now that she has her stock basis is zero, right, because it's been completely eliminated from the non-deductible expenses. When we look at her allowable losses, down in Part 3. So Part 3, this is the line 1 ordinary losses on our K1, $8,017. And in column C here, we see that the loss allowable from stock basis is 0, right? Because she has no stock basis. Her stock basis has been completely depleted because of the non-deductible expenses. So the carryover amounts for Jane Doe here is $8,017 in ordinary losses. That's what's going to roll forward to next year. And then she is not going to have to carry forward any of the non-deductible expenses. And so this reconciliation shows the carry forward amount. So we can see here in column E for Jane, she had disallowed losses in the current year of $8,017. And then at the bottom here, where we had non-deductible expenses and credit adjustments, the $16,500 from the current year, we were able to use $6,021, right? Because that was the stock basis. And then the difference there, the roughly $10,000 and change, is not rolling forward, right? So we don't have an entry here for amounts that are rolled forward to the following year. Because again, remember, non-deductible expenses, without making that election, the excess just disappears, okay? Now, let's have a look at what happens when, actually first, let's have a look at Schedule E so you can see that we have the fake consulting group K1 entry here. So Part 2, we have her K1 from the consulting group. It's an S Corp. And then we see here the non-passive loss allowed is 0, right? So remember, that jives with what we saw in the 7203, right? She has no stock basis to claim the losses, so the non-passive loss allowed for the current period is simply 0, right? That's it. All right, so now let's have a look at what happens if she decided to make this election, this 1367-1G election. So this example, everything's the same, right? All the income and loss items from the K1 are the same. Same block of stock, original shareholder. But now in item E, we are checking here to indicate that we have made this election during the period under 1.1367-1G. Okay, so now the numbers are for the most part the same, right? We have a $6,000 increase from the capital contributions, positive amounts of interest here. So her basis before distributions and non-deductible items is $6,021. Now, notice here the software has populated these messages for us. Kind of hard to read, at least this line item here. But what we're saying here is that the S Corporation shareholder is elected to take allowable losses first. So when you take this election to claim the losses first, right, the Form 7203, we skip over lines 8A, B, and C by leaving those blank, and then any amounts that we would have had there just get reported on line 13. So if we look here, we have 8A, 8B, and C. Remember, in the previous example, we had an entry for 8A because we had to claim the non-deductible expenses first. Now we're not doing that, right? So what we're doing now is we're skipping these and we're going down to line 10, right? What is our stock basis before loss and deduction items? It's $6,021. And so now when we jump down to Part 3, we have the same amount of ordinary losses from the K1, right? There's the $8,017. But now because we have some stock basis, we can claim some of these losses. So the loss allowable from our stock basis is $6,021, right? Because we add A and B and we ask ourselves, okay, is this amount greater than the number we have on line 10? And the answer is yes. So what that means is we can't claim all of the loss. We're going to have a loss allowable, but it's going to hit a ceiling on what our basis is. So we are able to claim $6,021 of losses. And so the excess there, the carryover amount, is $1,996. So that piece gets rolled forward to next year. Now, completing the rest of this, right? So it does ask us here on line 13. Now we would enter the items we would see on 8A, 8B, or 8C. So there's the non-deductible expenses, $16,500. Asks us on line 14 to total up these three lines, right? So 11, 12, and 13. And then so our stock basis at the end of the corporation tax year is still 0, right? Because we had some stock basis up here, but we completely wiped it out by claiming the ordinary losses. So basis at the end of the year is still 0, just like the previous example, but the way that we got there was different. The way that we got there in this example is by claiming the losses first and not the non-deductible expenses. All right. Now, what do we do again with that $16,500? Remember, we have to roll that a piece forward. So when we look at our stock basis roll forward worksheet here, now we have disallowed losses for the current year that are rolling forward to next year, right? So we do have some roll forward, right? We have 1,996 because we couldn't use all of it. And then notice the difference here on line 7 of this worksheet. So our non-deductible expenses is $16,500. None of it was able to be used in 2022, right? Because we used our losses first. So the full amount, the $16,500, has to be carried forward to next year, and it's going to reduce our basis for if we have any, right? So again, these things don't just disappear, right? If you make this election, you get the benefit of being able to claim these losses, but now you have to roll forward these non-deductible expenses indefinitely. So the $6,021, the loss that was allowable, notice how that updates our Schedule E. So Schedule E now, we have the same K1 from the consulting group, but notice here in non-passive income or loss, we have a non-passive loss that's being allowed for $6,021 because we do have basis now to claim at least some of the losses. All right. So I hope this was helpful. Again, it's not an easy decision to make because you have to weigh, the risk and reward against being able to claim the losses in the current year, but also be burdened by not being able to kind of just forget a lot of large non-deductible expenses, right? So really good, important to look at this and model how not only it impacts your current year, but what it's going to look like going forward. Because remember, again, once you make this election, you have to keep using it. So you have to carry forward the non-deductible expenses. You have to keep using this ordering treatment unless you get specific permission from the IRS to change that accounting method. All right, so that covers it for this video. Again, I hope that was helpful. Thank you for sticking with me to the end here, and I look forward to seeing you again on the next videos. Thank you.